Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 12th of October. I'm Daniel Lam, your host for the podcast. Over the last 12 months, we've seen solid pickup in client interest on investing in Indian assets, as performance from Chinese assets have been lackluster. We've talked about Indian equities a few times in this podcast this year. They're in a tug of war between high valuation premium versus very strong consensus EPS growth in excess of 20% in financial year 2023 and 2024. Today, however, we're going to explore a popular question that we've been hearing from clients, a very related question, i.e., can India replace China as a driver for global growth? Now, the short answer is no, not yet. Let's start by looking at the contribution to overall global GDP growth. Now, China's rapid industrialization of the past few decades helped to lift the overall global growth rate. However, we need to take notice that China's massive and persistent net export surpluses means that China actually takes away the global ex-China growth. Now, on the other hand, India's persistent net imports have been beneficial for global ex-India GDP growth, but the impact is small because India's net import is low relative to the global ex-Indian economy. So that's a mouthful of words. Let me give you numbers so you get a better picture. So China's import is at 3.1 trillion US dollar, or nearly 4% of the global ex-Chinese economy. Now compare that to India's 0.9 trillion, or 0.9% of global ex-Indian GDP. So you can see that it would be quite difficult for Indian imports to rise enough in order to offset any plausible slowdown in Chinese imports. Now, for the investors, it is especially important to see what these imports are at stake. So China imports and consumes about 50 to 60% of the global consumption of various industrial commodities. Now, by comparison, India's figures are between 2 to 6%. Basically, India's intake of industrial commodities is about 10 to 20 times smaller than China's, and India's consumption of oil is about 1/3 of China's. The Indian economy is much more services-led compared to China's. While India's industrial metal and industrial goods consumption is likely to continue expanding, it cannot offset the decline in Chinese demand for these goods. So with the slowdown in Chinese economy, industrial commodities prices are likely to face further headwind. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.